has declined to extend several key CARES Act lending programs that were funding emergency lending programs over at the Federal Reserve. They include the Main Street lending facility, the corporate bond purchases, as well as the municipal bond purchases. Those were the three key ones where most of the lending took place. The Federal Reserve, Fed Chair Jay Powell had made pretty clear in no uncertain terms that he wanted these programs extended beyond their expiration of December 31st. And Mnuchin saying no, he wants this money back. He has specifically requested that the Federal Reserve now send back some $420 billion that was available to the Fed for lending. Could have been trillions, but it didn't end up being very much. It was the very existence of the programs. Well, we, of course, first brought you this story about the split between Mnuchin and Powell on this issue earlier this week, and now a decision has been made in which Powell and Mnuchin, who have, I guess, worked pretty well together throughout most of this crisis, now going their separate ways on the issue of extending these emergency lending programs.
Steve, why? Why would the Treasury want to pull these important lifelines or potential lifelines as the virus crisis is getting worse? And while the economic crisis has gotten a lot better, is far from over, we still have millions of Americans unemployed and many small businesses and municipalities suffering. So
my understanding is that they believe that the markets have restored themselves, that the markets are trading well, especially the corporate bond market. I don't know what the rationale is on the Main Street lending facility, which is just now ramping up. And certainly you could make an argument many Main Street or mid-sized businesses, which are the target of these, need these funds. So that's unclear. On the muni market, it seems to be trading okay. On the other hand, you could argue there's a political reason, which is by giving this money back before a Biden administration takes over, it would deny them access to these funds and lending. Future lending would have to come from a much smaller pot of money, which is a $10 billion exchange stabilization fund that I know you know about, Sarah. That would be a much smaller pot of money that would leverage up to much less lending than otherwise would be available.
Welcome to the Crypto Teacher Stock Channel. And guys, you know I come with that video just to make you think on Saturday. We have Steve Mnuchin cutting some of the lending programs to the Fed. And of course, the Fed had just stated that we needed these programs. We have not fully recovered. We know that we have millions of people out of work. We know small businesses are nowhere near recovered. Also, we know that we have a $7 trillion Fed balance sheet. Plus, we have a stock market is at all-time highs. Now, what they're doing is shrinking liquidity, which will be ending December 31st. And like I had stated to you guys, the new treasurer does not take effect until in January. And then, of course, it's going to take them a while to get any new Fed program started. So, guys, we know the New World Order does what? Problem, reaction, solution. And we also know everything is planned out. Enjoy the rest of the video.
Productive capacity of the economy. And what that looks like is workers who are out of work for long periods of time. They may lose their contact with the labor market. They may lose their skills. And the evidence is strong that if you're out of work for a long time, it may be hard to get back the life that you had, get back to the work that you had. For families in particular, particularly women, leaving the workforce in big numbers now as children stay home. We're seeing that. And so you could see women who, not by preference, but by requirement, are at home and their careers may be hurt. And for businesses, something like this can lead to unnecessary insolvencies, and there are always going to be insolvencies, but there could be more than, and that would be tragic for particularly for smaller businesses, which may have taken generations to build. So we got a long way to go. The last thing I'll say is we're not going back to the same economy. We're going back to a different economy. And we can talk more about that, but this economy will be different, and that's going to mean that those people who worked in the service industry, they may need help and support for a time as they find work in new places. So the Fed will stay here and be strongly committed to using all of our tools to support the recovery for as long as it takes until the job is well and truly both be deployed to support the recovery, complementing one another, and together providing broad support of different kinds for the economy. And so far, I would say both have been deployed quite aggressively, and the faster than expected recovery that we've seen, reflects that fact. And I would also add that there's such a long way to go to get back to full employment, to get back to, frankly, to something close to the economy or akin to the economy we had just back in February. It's a long way to go, and I think it's likely the economy will continue to need support from both monetary policy and fiscal policy. So it's essentially what our tools allow us to do is to stimulate aggregate demand by lowering interest rates and also to support the flow of credit in the economy. These are really important powers. They're very strong powers, and we've used them historically in historically aggressive ways, and appropriately so. And as I mentioned earlier, we'll continue to do so until the job is done. But this is far from a traditional economic downturn. Suddenly, in March and April, tens of millions of people were suddenly unemployed because effectively a natural disaster happened and forced a lockdown of certain parts of the economy. And as I mentioned, the burdens fell particularly on those least able to bear them. So beyond monetary policy, what fiscal policy can do is it can provide, this is taxing and spending, can provide direct targeted income support for groups that really need it. And there hasn't been a bigger need for it in a long, long time here. And those powers to tax and spend are strictly the province of our elected representatives in Congress. They get to decide who bears the costs and who gets the benefits of those things. And it's essential in our system that it be elected representatives who do so. And in the CARES Act and a couple other bills they passed, this is the largest and fastest done too much. And, is that going to, put us on a path to an unsustainable fiscal path? The truth is we're already on one. It's not an emergency. The way you get back on a sustainable path is you have the economy growing faster than the debt for a long, long period of time. That's what a successful program looks like. And we will go to work on that when the economy is ready for it, I would hope, in a perfect world. And that's the way that'll work. In terms of what we do, we use our emergency tools. So we have particular tools, the lending tools that we've used to lend to state and local governments and non-financial businesses and others. Those are all available with the permission of the Secretary of the Treasury under unusual and exigent circumstances, which means in an emergency. So we're using them. When the time comes, we'll put those tools away. And no one wants the Federal Reserve to take over the function of private lending in the economy. These tools are only available when the private lending markets break down, and they did in March and April. So we came in, and the markets have reopened, and when the right time comes, and I don't think that time is yet or very soon, we'll put those tools away, as I've said. So, and there shouldn't be any long-term effects of that. I don't think that monetary policy, the whole point is for us, the goal for us is to support maximum employment and stable prices. Neither of those goals is put at risk in the long run by the actions we're taking now. Far from it. We're actually doing what we can to.
Well, let's focus on the Fed side of the equation for a moment. The balance sheet of the Federal Reserve Bank has grown from $900 billion in 2007 to over $7 trillion today. In 2012, when the Fed started to taper, there was the taper tantrum. And in 2018, there was another tantrum with respect to the autopilot that was announced, a program of slowing the buying of securities. So how and when do you see the Fed getting the balance sheet back to some sense of normal, by which I mean neither stimulative nor restrictive policy?
Okay, so Alex, I would say it's really premature to even think about normalizing to think about the size of the balance sheet and things like that. We're focused for now on achieving the goals that Congress has given, maximum employment and price stability, and we'll start to think about when it's time to slow down our purchases, which would slow the growth of the balance sheet, and take further steps going forward. We'll start to think about that when there's been a whole lot more progress toward those goals. But I would say, based on our experience, some of which you mentioned, we do know the steps to take, and we know that we need to carefully communicate those steps well in advance. And what we wound up doing after the global financial crisis was, in 2013, we announced that we would gradually taper our asset purchases. So they ended about a year later. So gradual move. And then the size of the balance sheet was held constant for several years. And as the economy grows, then the ratio of the Fed's balance sheet to the size of the economy shrinks. So that's what we can do. I would also say, though, in terms of, I won't go into all the detail, but what really sets the size of the Fed's balance sheet in the longer run is the public's demand for our liabilities. This probably isn't widely understood, but with the Fed is like a bank in the sense that we have assets and liabilities. We're like a small bank, except we're not small, but our balance sheet is actually less complicated than a commercial bank's is. And so we have our principal liabilities that make up for most of our liabilities are currency. And everyone knows what currency is, and the public demands that. Of course, currency is an asset in the hands of the public, and also bank reserves, which is just commercial bank deposits at reserve banks. So, and those are assets to the commercial banks, but to us, they're liabilities that we issue. So, ultimately, a lot of the growth in the balance sheet after the global financial crisis was because of increasing demand from the public for currency, and even more than that, increasing demand from the banks for bank reserves. And the reason there was so much demand for bank reserves was that banks were required to hold very much higher quantities of highly liquid assets. And one of the most favored kinds of highly liquid asset, all of the assets that we create are effectively risk-free. So they're very popular for banks. That's where a lot of the growth of the balance sheet came in. But ultimately, that's a question we will return to, and we'll use, we have a playbook, and we'll no doubt we'll improve upon it. But we know, I think, how to normalize policy over time. And one key is telegraphing everything you're going to do well in advance to avoid surprise.